Hello, my dear students. Welcome to my video lecture series. I am your very own Rohit Kumar Srivastav, and I am going to explain the dynamics of budgeting, calculation, and estimation in this video lecture. Before understanding what is budgeting, let's first of all understand what budget is. A budget is merely a plan relating to a period of time expressed in quantitative terms. In the business world, a budget is the formal expression of the expected incomes and expenditure for a definite future period. In other words, a budget is a predetermined statement of management policy during a given period which provides a standard for comparison with the results actually achieved. Now, the act of preparing the budget is basically called as budgeting. So, the entire process of preparing the budget is known as budgeting. Now, we are not going to discuss in detail regarding the objectives, limitations, advantages of budgetary control. Let's start with the practical situation which we are going to face in the estimation and calculation of budget. In this chapter, we are going to study the different kind of method of calculating the budget. The first method may be classified into two different categories: fixed and flexible budget estimation. The fixed budget is that budget which is prepared keeping in mind one level of activity. It is defined as a budget which is designed to remain unchanged irrespective of the level of activity attained. On the other hand, the flexible budget is designed to change in relation to the level of activity attained. So, we can say that a fixed budget will remain fixed irrespective of the level of activity attained, and the flexible budget gives us a flexibility to convert our total budget according to the total amount of unit which is going to be produced by our organization. The next method of budget is the cash budget. Basically, it is one of the most important and one of the last to be prepared. It is a detailed estimate of cash receipts from all sources and cash payment for all purpose and the resultant cash balance during the budget period. It makes certain that the business has sufficient cash available to meet its need as and when these arise. It is a device for coordinating and controlling the financial side of the business to ensure solvency and provide a basis for planning required to cover up any deficiency in cash. Basically, from this chapter, the students will face two questions. First, from the flexible budget, and second, from the cash budget. First of all, let's discuss the modalities of flexible budget. Now, we are going to solve one question based on the flexible budget. There is one question: draw up a flexible budget for overhead expenses on the basis of the following data and determine the overhead rates at 70%, 80%, and 90% plant capacity. Now the amount has been given, like variable overhead, indirect labor, stores including spares, semi-variable overhead like power, 30% fixed, 70% variable, repair and maintenance, 60% fixed, 40% variable. Now the fixed overheads like depreciation, insurance, salaries, and the total overhead amount which is given as 62,000, and estimated direct labor hours 1,24,000 hours. Now basically we are required to calculate the overhead rate at 70%, 80% and 90% plant capacity. Basically, in the flexible budget method, we will have the two different kind of format on the basis of which the question will be solved. The first format has already been given in this question, like segregation of total overhead into variable, semi-variable and fixed overhead. And the second format is to identify variable overheads first and then to classify the total fixed overheads in the second, and then combining the total variable overheads and total fixed overheads, which will give us the total overheads cost. Now let's solve this question. Since the data has already been given at 80% capacity, so the students are just required to fill the data at 80% capacity, which has already been given in the question. The format shall be in the same manner in the manner the question has been asked. First of all, write down the variable overhead like indirect labor 12,000, stores including spares 4,000, then semi-variable overhead, power fixed 6,000, variable 14,000. Now here we are required to make a note that if some amount has been given as fixed and variable in the semi-variable overhead, so we need to show it separately, like power has been given as 30% fixed and 70% variable. So we need to require distribute the total 20,000 rupees of power amount into 30% fixed, which is 6,000, and 70% variable, which is 14,000. Now again, we need to keep in mind that this 6,000 rupees of fixed amount for power shall remain fixed at 70%, 90% and even at 100% capacity, because this is a fixed cost and we know very well that the fixed cost will remain fixed throughout the level of activity. Now next, repair and maintenance. Since the fixed cost is 60% and variable cost is 40%, so we need to again segregate this amount into two different cost. First of all, write down the fixed cost 60% of 2000, that is 1200, and now the variable cost, which is 40% of 2000, which is 800. Now the fixed overheads, depreciation 11,000, insurance 3,000, salaries 10,000. Now the total overhead value coming out to be 62,000. Now the estimated direct labor hour has already been given as 1,24,000. So we need to just divide the total overhead cost with estimated direct labor hours given, that is 1,24,000. So the direct labor hour rate is 0.50. Now calculate the values at 70% capacity. First of all, the indirect labor amount. Now we know very well that the 12,000 rupees of indirect labor occurred at 80% capacity. So we need to just convert this amount at 70% capacity, because the amount has already been given at 80% capacity and it is since variable cost, so we can modify or convert according to the level of operation. So simply multiply this 12,000 with the required amount of capacity, that is 70%, and divide from that percentage at which the data has already been given in the initial terms. that is 80%. So 12,000 into 70% divided by 80%, that is 10,500, will be the required amount at 70% capacity. Similarly, the stores including spares will be calculated like 4,000 multiplied by 70% capacity divided by 80% capacity, and this will give us the 3,500 rupees of required amount. Now, coming to the semi-variable overheads, we know very well that the fixed amount for power is 6,000 at 80% capacity, so it will be fixed at 6,000 for 70% and 90% capacity too. But we need to convert the variable cost according to the level of activity. So divide this 14,000 by 80% and multiply by 70%, we will get 12,250 for variable cost of power in the semi-variable overhead. Now next, repair and maintenance. The fixed amount has already been calculated as 1200, so we need to calculate the variable cost according to the 70% capacity. So the 800 rupees of repair and maintenance cost was there in the variable cost context at 80% capacity. So just divide this 800 rupees by 80% and multiply by 70%. It will give us 700 rupees of variable repair and maintenance cost. Now coming to the fixed overhead, the depreciation amount 11,000, insurance 3,000 and salary 10,000 will remain fixed. So we do not need to calculate this. The total overhead cost now coming out to be 58,150. Now just divide this amount with the 70% capacity of direct labor hours. So again, convert this 1,24,000 direct labor hours at 80% capacity according to the 70% capacity. So what we will do is 1,24,000 into 70% divided by 80%, if it become 1,08,500. So basically the direct labor hour rate coming out to be at this 70% capacity is 0.536. So similarly, the values will also be calculated at 90% capacity, and we will have the total overhead amount at 90% capacity as 65850, and we will divide this amount by 1,39,500, which will give us the direct labor hour rate as 0.72. That's all.